How you doing? I'm Big D. Welcome to the show. What I have to share with you today, they're not going to be able to hide this any longer. And I believe the silver prices are going to explode. Let me know in the comment section after you watch this show of what you believe. And if you think it's going to explode. Or do you think they're going to stay the same or maybe even have another pullback? Well, let's get right to it. Now I have officially, in my opinion, entered the realm of impossible. Now for the last 48 hours, we've been analyzing the symptoms of the market. We've looked at the crash all the way back to $86. We looked at the doors closing of the US Mint. We looked at their $13 premiums in Shanghai. Now, these were all clues. They were the smoke signals telling us that fire was burning somewhere deep inside the financial system. But today, Sunday, January 18th, 2026, rumors are circulating that suggest the fire is much larger than anyone has even considered. We're looking at a highly controversial, unverified ledger that has gone viral across the institution trading desks this morning. This document purports to show to the shadow portions in the short positions of the largest banks in the world, positions that are hiding in over-the-counter derivatives markets and do not appear on the official government reports. The numbers on this page are not just bad, they are terminal. According to these leaked estimates, two of the largest banks in the United States, Bank of America and Citigroup, could be sitting on a combined net liability of up to 4.4 billion ounces of silver. Let me repeat that, because it's so large that it sounds almost fictional. 4.4 billion ounces. Remember, they only mine 800 million ounces per year. That is just a mind-boggling number. Now, official commitment of traders report shows a short position of around 500 million ounces. That is already massive. But if this leak is true, which it's showing to be very interesting, if not true, but I have to believe this is 100% there. Now, if the banks have hidden another 4 billion ounces in off-sheet derivatives, then the math of the silver market is fundamentally broken. To understand why this would be the death sentence for these institutions, you have to understand the physical reality of silver markets. The entire global mining industry, every mine in Mexico, Peru, China, Russia, Australia, combined produce approximately 800 million ounces of silver per year. This is the hard ceiling. We cannot print more. We cannot dig up any faster. So do the math. If global production is 800 million ounces, and these banks have already sold 4.4 billion ounces, they have effectively sold 5.5 years of total global supply. They have sold silver that has not been mined yet. They have sold silver that will not be dug up out of the ground until 2031. This is textbook definition of naked short. You have a sold promise that they cannot physically keep. In a normal market, a short seller borrows an asset, sells it in hopes to buy back cheaper, and hope and pray to get it back cheaper. But to do that, the asset has to exit. You have to be able to find it. Where the Bank of America and Citigroup, where are they going to find this 4 billion ounces of silver? They cannot find it in the COMEX. The registered inventory is down to 120 million ounces. They cannot find it in the US Mint. The Mint is and is suspended sales. They cannot find it in London. The vaults are empty. Whether the number is 500 million or 4 billion, they are trapped in a mathematical prison of their own making. This explains that the violence we saw on Thursday, now remember, a flash crash. Remember how the price dropped from $92 to $86 in a few minutes? The media told you that that was making profit, or profit taking, my apologies. Media told you it was a technical correction. They were likely lying, because, I mean, the math is there. The crash looks exactly like a desperate survival level attempt to manage liability that is spiraling out of control. Every time the price of silver goes up by $1, a short position of 4 billion ounces loses 4 billion. When silver went from $50 to $90, if those rumors are true, they lost roughly $160 billion in paper value. This is why they smashed the price. They smashed it down with derivatives and the fake silver, you know, that whole scenario. They were not trying to make money. They were trying to stop the bleeding. They were trying to prevent a margin call that would liquidate the bank. But here's the problem with a naked short of this magnitude. It creates a black hole in the market, because they have 5 times more silver than exists in the annual supply. They have created a future demand that is 5 times larger than the future supply. Eventually, they have to close these positions. They have to buy back the contracts. Who are they going to buy from? Are they going to buy them from you? Are they going to buy from Samsung? Are they going to buy from the Chinese government? Nobody is selling. This is why the price bounce back was so quickly. The market realized the short interest, whether official or shadow, it actually just future buying pressure. Every short position is a guaranteed future buyer. Bank of America is not a seller of silver. They are a guaranteed buyer of silver. They just haven't bought it yet. The realization flips the entire narrative on its head. We're not looking at the market that is overbought. We are looking at the market that is oversold to a degree that has never happened in the history of finance. If the shadow leverage is real, we are looking at a short interest relative to annual production of 550% compared to the Volkswagen squeeze in 2008. In that squeeze, the short interest was roughly 12% of the float, and the price went up 500% in a day. Compare it to GameStop's stop squeeze. Remember that? The short interest was 140%, and the price went up 1,000%. We're looking at a potential short interest that dwarfs anything we have ever seen. The potential energy stored in that trade is nuclear. And this brings us to the counterparty risk. If you hold paper contracts for silver on the COMEX, who is on the other side of what trade? Who promises to deliver the silver to you? It is likely one of the massive banks. And if they owe billions of ounces, they only have access to maybe 50 million ounces in their vaults. They are insolvent. They cannot deliver. This means that the millions of people holding paper silver are holding the contract with a bankrupt entity. They are holding a promise from someone who cannot pay. This is why the physical silver and the physical price is decoupling. The physical market suspects that the paper market is a fraud. When dealers charge $120 for a coin, they are pricing it in the risk that the bank will fail. They're pricing in the reality that paper contracts are worthless because the metal doesn't exist. We have spent years talking about manipulation on this show. And we talk about spoofing. We talk about capping. But this leaked data changes the conversation. This isn't just manipulation. This is recklessness on a scale that threatens the stability of the entire global financial system. These banks have supposedly bet the house against the silver, and silver is winning. In the next part, the deep dive that I'm going to bring to you, we're going to calculate the insolvent, the big numbers. We are going to take a current price of $90, multiply it by this rumored short position, and show you the whole in their balance sheet. They're going to compromise. We're going to compare the number to the total equity of these banks. And we're going to show you why the Federal Reserve will have no choice but to intervene. But they won't intervene by finding more silver. They will intervene by printing more dollars. The math is terminal. The liability is absolute, and the clock is ticking. We have established a premise based on a leaked data circulation on the internet, institutional desks that Bank of America and Citigroup may be holding combined shadow short position of 4.4 billion ounces of silver. Now we must do math that the mainstream media is too afraid to do. We must calculate the mark-to-market damage. We must quantify the hole in the hull of the ship. Take the current price of silver, let's call it $90 because that's what it closed at on Friday, roughly $90.88, I believe it was. Keep the math simple. Let's stick with $90 by 4.4 billion ounces. The result is $396 billion. Let that number sink in a little bit. This is not a trading loss. This is not a bad quarter. This is not I don't know how you put it, but to put this number into perspective, let's look at the market capitalization of these banks. The market cap and the total value of every single share of stock the bank had issued. It is what the market thinks the entire company's worth. Okay, so Citigroup is a market cap of roughly 120 billion. Bank of America has a market cap of roughly 260 billion. If you add them together, they combine equity value in roughly $380 billion. The liability from the short position, if you don't remember, I just told you a few minutes ago, $396 billion. It is larger than the value of the banks themselves. If they were forced to cover this position at $90 today, they would be wiped out. Remember, banks are too big to fail. Remember 2008? I think it was Obama that used to come out. Yeah, that smart guy. Their equity would be zero. Their shareholders would be zeroed out. The bank would technically be bankrupt. And that assumes they could cover at $90. What if it goes higher? But as we discussed in the beginning, if they tried to buy 4 billion ounces, the price wouldn't stay at $90. It would probably go to about $500. This is my math. Go with me. So the liability isn't 390 billion. It isn't theoretically infinite. The equation is the key to understanding the insane volatility we witnessed on Thursday. When silver hit $92, the algorithm at the risk desk started flashing red. The liability was crossing the threshold of the bank tier 1 capital reserves. They were facing an immediate margin call for the clearinghouse. They had two choices. Choice A, admit defeat. Buy back the shorts, send the price to the moon, and declare bankruptcy. Or choice B, sell everything they had, paper contracts, gold equities, smash the price of silver back down to $86. They took choice B. By smashing the price from $92 to $86, they reduced the price by $6 per ounce. 4.4 billion ounces is 26.4 billion in a matter of minutes. They reduced their paper liability by 26 billion. That is enough to satisfy the margin clerk for one more day. That is enough to keep the lights on for one more night. This wasn't trading. This was survival mode. They were not trying to profit. They were trying to avoid immediate liquidation. But here's the catch. This strategy only works if the price stays down. But the price didn't stay down. It ripped right back up to $90. The 26 billion of relief evaporated as fast as it appeared. They are right back where they started, but with one major difference. They have used up their ammunition. They have exhausted their ability to shock the market. And while were fighting the paper war on the screen, the physical market is sending a signal that confirms that they are already dead. The signal is backwardation. In a normal market for a non-perishable commodity like silver, the future price should be higher than the spot price. This is called contango. It costs money to store silver, to insure it, to secure it. So silver for delivery in 6 months should cost more than the silver delivery today. But right now, the market is in backwardation. The price of spot is higher than the future price. And critically, the lease rates are skyrocketing. The lease rate in the cost to borrow physical silver, if you are a bank and you're short, you can try to lease silver from someone else to deliver it and kick the can down the road. When lease rates go vertical, as they are doing right now, it means there's no silver available to borrow. The owner of silver, what they're saying is, no, I won't lend it to you. I want it in my vault. This is the physical market screaming that there's a shortage. And when you combine 4 billion ounces paper short with a physical market and backwardation, you get a death spiral. The bank needs to borrow silver to cover their shorts, but they can't. They can't borrow it because lease rates are too high. So they have to buy it, but they can't find it anywhere because the price is too high and they are insolvent. So they try to smash the price down, but the smash fails because the physical buyer steps up. It is a trap with no exit. This brings us to systemic risk implied by this leak. If Bank of America and Citigroup are insolvent because of silver, this is not just a silver problem, it is a global financial problem. These banks are global, systematically important banks. They are the plumbing of the world economy. If they fail, the derivatives market freezes, the credit market freezes, ATMs stop working. This is why the Federal Reserve and the U.S. Treasury are involved. They know about this silver short. They have seen the ledger. Why do you think Treasury Secretary Bessent called an emergency G7 meeting? Why do you think the U.S. Mint suspended sales? They are trying to manage the collapse of the short position without destroying the dollar. They're trying to engineer a soft landing for the 4 billion ounce bomb. They are in no soft landing for a naked, there is no soft landing for a naked short in a commodity shortage. There's only a hard landing. The only way to save the bank is to bail them out. The Federal Reserve will have to print $390 billion and likely much more to cover their losses. They will have to monetize the silver short. This means that the price of silver isn't just going up because of supply and demand. It is going up because it's being repriced in the currency that is about to be diluted to save the banking industry or the banking system. We are watching the setup for the greatest transfer of wealth in human history. The wealth is transferring from banks who sold paper to the individuals who bought silver, physical silver. But the equation has been solved. The result is 0 for banks and infinity for the metal. But history tells us that this kind of event doesn't happen in a vacuum. It happens in a cycle. It happens according to the rhythm that has repeated for over 100 years. There is a chart, a pattern that predicts this exact moment. It predicted that the year 2026 would be the year of the commodity boom and the stock market bust. In the next part of the deep dive, we're going to look at the Benner cycle. We're going to show you that the chart drawn over 100 years ago that pointed to this specific year and the turning point. We're going to explain why the trap the banks have fallen into is predictable, cyclical, and inevitable. The banks are fighting math. They're fighting physics, and now they're fighting history. The $390 billion bill that has come true, and they cannot pay. We have analyzed the impossible math of the 4.4 billion ounces in the short position. We have dissected the insolvency equation that threatens the wipeout of the equity of the world's largest banks. But to truly understand why this is happening right now, why the system is breaking, January 2026, and not a year earlier or year later, we have to look beyond the balance sheets. We have to look at the rhythm of the history itself. There is a chart that has been circulating quietly among the most elite macro investors for decades. It is not a chart produced by Goldman Sachs algorithm. It is not a chart generated by artificial intelligence. It is a hand-drawn chart from the year 1875. It was created by a prosperous Ohio farmer named Samuel Benner. Benner noticed that the market panics, commodity booms, and financial crashes following a specific repeatable pattern. He mapped this pattern out on a piece of paper over 150 years ago. He called it the Benner cycle. For a century and a half, this chart has predicted almost every major financial turn point with terrifying accuracy. It predicted the panic of 1929. It predicted the bottom of the 1932. It predicted the dot-com bubble in 2000. I mean, this is someone who's back in, the 1800s. How do you know about this stuff? You know what I mean? And now, he also predicted the crash of 2008. And we're looking at a chart again. And there's a red circle around the year 2026, according to the Benner cycle. 2026 is designated as a year of good times, high prices, and a time to sell stocks and value of all kinds. You might hear good times and think that sounds positive for the banks. But you have to understand that the Benner meant in his cycle, high prices marks the blow off top. It marks the peak of the mania. It marks the moment of maximum danger where the smart money exists, the paper money market, before the crash. It says explicitly, time to sell stocks. This is the prophecy that the banks ignore. Bank of America, Citigroup, their massive short positions in silver based on the assumption that the paper age would last forever. They assumed that they could suppress commodity prices infinitely or indefinitely, while the stock market and the bond market climbed to the moon. They bet against the cycle. The Benner cycle dictates that capital rotates. It moves from paper assets like stocks and bonds into hard assets like commodities and land. This rotation happens at a peak of a cycle then when confidence in the paper system is highly at its highest just before it collapses. We're living through that exact pivotal point right now. The short squeeze in silver is not an isolated event. It is the mechanism by which the Benner cycle enforced its will. Think about it. The banks are short silver. That means that they're betting that the price of hard assets will go down. But the cycle says that we are entering a period where paper assets crash and hard assets explode. They're standing on the beach trying to hold back the tide of history with a paper contract. This explains why they are trapped. They didn't just make a bad trade. They made a fundamental error in judging that the economic season. They're trying to harvest crops in the middle of winter. When the Benner cycle turns, the flows of capital become irresistible. We're talking about hundreds of trillions of dollars in a global market, a global wealth looking for a new home. If the cycle says sell stocks, where does the money go? It can go into bonds because inflation destroys bonds. It cannot go into bonds, because inflation destroys bonds. It cannot go into cash because the dollar is losing value daily. It has to go into commodities. It has to go into the Industrial Revolution material we discussed. Silver, copper, lithium, things like that. Now, I don't know if you've seen into what's going on with copper, but it's going crazy. Pricing, it hasn't stopped. It's continually going up. Now, this creates the commodity supercycle. The banks are short the supercycle. They are short that that's very how do you put it? They're whatever the entire world is trying to buy. And this brings us back to the trap. Why did the bank build such a massive naked short position? Were they that stupid? No, they were arrogant. They believed that they were the market, so to speak. They believed that because they could print unlimited paper contracts, they could override the laws of supply and demand. They believed they could override the cycles of history. This is the hybris that always precedes that fall. In 2008, the banks believed that the housing prices could never fall nationwide. Here, there, maybe, but not nationwide. They built a derivative empire on the false assumption. And when the cycle turned, they were wiped out. In 2026, they believed that silver could never break $100. They built a 4 billion ounce short position on that assumption. And now that cycle is turned. They are wiped out again. But this time, the bailout will be harder. In 2008, they just had to print money to fill the hole. This time, they need physical metal to fill that hole. And you cannot print silver. The Benner cycle chart is a warning from the past. It tells us that these moments of high prices and selling stocks are followed by years of hard times. Hard times for who? Hard times for the holders of paper. Hard times for the people who trusted the banks. Hard times for people who stayed in the stock market too long. But for the people who hold the real asset, silver, gold, land, these are not hard times. These are times of wealth transfer. The banks are fighting to keep the good times of the paper market going for just one more month. Excuse me. One more week, or even one more day. This is why they smashed the price to $86. They're trying to delay the inevitable turning of the calendar. But the time only moves in one direction. The year is 2026. The cycle has arrived. The great rotation from paper to metal is happening. The leaked ledger we discussed is part one, shows us that the magnitude of their bet. The Benner cycle shows us the futility of their bet. They have bet 4.4 billion ounces of silver that history is wrong. I wouldn't take that bet. This historical context is critical because it tells you that the volatility we are seeing, the violent swing, the desperate smash is not chaos. It is the sound of paradigm shift. It is the sound of tectonic plates of the financial world grinding against each other as the pressure builds. The banks are on the wrong plate. They are on the plate that is sinking. You, the silver holders, are on the rising plate. And this brings us to the end game of this specific crisis. If the banks are insolvent, if the cycle is turned, and if the physical metal is gone, what is next? What is the next logical step? How does a bank exit a trade when it owes metal? It cannot buy and cannot borrow. There's only one way out. It is a legal clause hidden deep in the fine print of the future contracts. It is a clause that most investors have never read and never thought would be used. It is called force majeure, or in plain English, cash settlement. In the final part of this deep dive, we are going to explore a force scenario where we're going to explain exactly what happens when Bank of America and Citigroup declare that they cannot deliver the silver. We're going to look at the wholesale freeze that has already started. Dealers are quoting 6 weeks delay. I hear it's more like 8 to 10 weeks. The system is preparing for default, and when they default, the price on the screen, whether it's 80, 90, 100, becomes meaningless. The price becomes infinite because you cannot buy it. The Banner cycle predicted the turning point. The leaked ledger revealed the victim, and the force will deliver the final blow. We are witnessing the death of the paper derivative market in real time. Welcome to the commodity supercycle. We have arrived at the conclusion. If you have been with me through this whole discussion, you now understand the terrifying scope of the trap that the banks have built for themselves. You understand the impossible math of 4.4 billion ounces in a short position. You understand the insolvent equation that threatens to wipe out the equity of the Western banking system. And you understand the Benner prophecy that predicted the exact amount in history over 150 years ago. The evidence is overwhelming. It is not a theory. It is a mathematical inevitability. We're not looking at a trading correction. We're not looking at a normal market cycle. We are looking at the end of the paper derivatives, or what I call fake paper silver. So how does this end? How do the banks escape $390 billion liability when they do not have the metal to cover it? They do not buy the metal. They cannot buy the metal. They do not deliver the metal. They declare force. This is the legal term that has been whispered in the back rooms of the commodities market for weeks. It is a French term, major, I believe it's pronounced. It is the escape hatch. It allows a party to break a contract without penalty if they prevent it from fulfilling it by an event beyond their control. Usually force majeure is reserved for acts of God. Earthquakes, hurricanes, wars. I don't know how they put wars in there, but that's not an act of God. But in the coming days or weeks, we believe the bullion banks will be attempting to use it to describe the unprecedented market conditions that they created. They will claim that Shanghai squeeze, because Shanghai price of silver is higher than the United States, COMEX, the LBMA, etc. I believe this is going to be very exciting for some, if you're a silver holder. If you're a certificate holder, paper silver, blah, 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 I don't think you're going to be happy. I'm not telling you what to do, but if I was in your position, I owned a bunch of paper silver, I'd ask for my money. I'd ask for my silver, whatever you're going to do. But I would bail out for now. But that's what I would do. I'm not a financial guru. I'm not a financial advisor. I'm not telling you to run out and buy, sell, trade, nothing. I'm just giving you some information that came across, and I've been looking at this for about almost a week now. Now, I'm saying that they will trigger the cash settlement clause. Every future contract on the COMEX has fine print, and that fine print says that if physical delivery cannot be made, the exchange has the right to settle the contract in cash. Again, see if you can get your money. This is the nightmare scenario for paper holders. Imagine you bought a futures contract at $30 and the price goes to 90, which it's right around there, right? You think you are rich. You stand to deliver because you want the silver. But instead of sending you a 5,000 ounce bar of silver, the bank sends you a check for the dollar difference. I think I would be okay with that. But they say, here's your profit. The contract is closed. Have a nice day. You might think, great, I made some money. But you miss the point. You didn't want dollars. You wanted silver. By the time you get the check and you want to try to take those dollars and go to a physical dealer and buy some actual metal, the price on the street might go up considerably. You have been cash settled out of your position at an artificial price while the real asset has moved out of your reach. This is also starting to happen in the wholesale markets. We are hearing reports of industrial buyers that dealers are quoting unavailable or 6-week delay for volume deliveries. When a wholesaler tells you 6 weeks, they're praying that they can find the metal by then. It is a soft default, but when they force major announcement hits the news wires, it will be a hard fault of the two markets. When we've talked about separation of paper and physical before, but in a force majeure scenario, the separation becomes permanent. The COMEX price becomes a museum exhibit. It becomes a zombie number on a screen that nobody can actually trade. Meanwhile, the street price, the price you pay to hold the metal in your hands, goes vertical. Our analysts suggest that when the first major short declares force majeure, the street price will gap from $90 to $150 even overnight. Why 150? Because this is the price where the panic buying becomes absolute. That is a price where Samsung, Tesla realize that the paper market is broken, and they're start bidding directly against each other for the remaining stockpile, because these are the companies that need a lot of ounces of silver every year. Solar panels, electric cars, Samsung battery makers, because they're going to require a huge amount of silver, let alone your cell phone, laptops, any electronic device. Now, a super cycle isn't just a bull market. It is a period where commodities become the dominant form of collateral in the global market, global economy. It is a period where he who has the gold, or in this case silver market, rules. The banks are fighting to prevent this because they deal in paper. If paper becomes worthless, they become irrelevant, but they cannot stop it. The Benner cycle turns regardless of the Federal Reserve wishes. The equation must be balanced. So what is the final verdict for you? The individual investor, you are standing at the precipice of the greatest wealth transfer in history. But the participant in it must follow one simple rule. Do not accept the cash settlement. If you own physical silver, you have already won. You have exited the system. You hold the asset that the bank owed, but cannot deliver. Do not sell it to them. They are shaking the tree one last time. The volatility we saw this week, the crash to $86, the rip to 92, is designed to make you let go. They want your physical metal because it is the only thing that can save them. If you sell at 90, you're bailing out Bank of America, Citigroup. You're giving them the life raft that they need to survive. I don't think it's going to help, but it is possible. Now hold your position. The real price of silver is not on the screen right now. The screen is a fiction maintained by an algorithm that are about to be turned off. Don't take it as I know exactly what's going on, but take it as what has gone on in the history. I believe the COMEX is about to be shut down. The LBMA about to be shut down. This is my belief. I do not have a crystal ball, but the real price is determined by the unobtainable factor. How much is a missile worth if it cannot build it? Think about that. Every missile, there's a lot of silver that goes into it, the military arsenal. Missiles, okay? Solar panels. I can't say enough about what we have on our plate that silver goes into. How much is a solar panel worth if you cannot coat it with silver? Silver is not just a trade. This is the linchpin of the Industrial Revolution, and the banks have shorted the Industrial Revolution. They are betting against the future. You are investing in it. This is why the force majeure is inevitable. They have promised the future, or to deliver the future, but they sold it all in the past. When the announcement comes, and it could be next week, next month, I believe it's going to be soon. Do not panic. Do not look at the news anchors who will tell you the market is broken or frozen. Understand that the freeze in the confirmation, it means the paper game is over. It means the price discovery mechanism is moving from New York to Shanghai. And I don't think the LBMA is going to be part of it. I think Shanghai is going to be the one to look at. They are the only ones who are showing a difference versus the COMEX and the Shanghai. It is moving from derivative desk to the physical vault. We are witnessing the death of the illusion and the birth of reality. Bank of America and Citigroup are sitting on $390 billion mistake. Do not let their mistake become your loss. Let it be your gain. The clock is ticking. The vaults are empty. The cycle is turning. Welcome to the age of real money. Please subscribe. Smash the like button. I'm building a show here, and I do need your help. You try to have a great rest of your day, and God bless. Have a great one. Be safe.